I'd like to review what we did last week, and for any of you that are new to this week's class, this is a part 2 of a 2-part series. The first series that we covered last week, we covered 2 main topics. It was the loan process, and then it was the 3 silos of home loans that are available to consumers today. And if you have any interest in this at all, I do teach this class repetitively, and also it's online as a class in the education section of OCAR's website. So we can get to that also. You can get to it that way. But what we did teach was the loan process, and it started from the application online to collecting the customer's documents, to structuring the loan, to processing the loan, to underwriting the loan and getting a clear to close, the funder balances with the escrow officer prior to docs going out. The notary takes the docs, gets them signed, returned to escrow, and then we fund and we close. And each of those milestones have to be hit, and you can't leapfrog them, and you can't jump ahead and come back. They've got to go in order. And there's time delays based on who's doing what at any given time of the day and the week and the month and the year. You're in line with multiple, hundreds of other loans. Are there times when we can leapfrog? The answer is yes. The process is it's one to know and understand, so you can coach your buyers and sellers, for that matter, accordingly, and explain to them what to expect and why it's happening. And me and my team, we keep you fully informed every step of the way, every milestone, because that's the most important thing, is a line of communication. And when we know there's issues or problems, we don't wait a day or two to figure that out. We hit them immediately. The second thing we covered was the 3 loan silos, and those silos were your loans that required proof of income. They're called tax return loans. They require the customer's tax returns, pay stubs, W-2s, 1099s, whatever, to verify their income. That's your Fannie Mae loans, your Freddie Mac loans, your FHA loans, your VA loans, your USDA loans, as well as all jumbo loans. Okay. Silo number 1 is the hardest to qualify for. And in that silo, because they're harder to qualify for and the income is documented, they're the least riskiest loans. The second silo is a silo that we call the Wall Street loans, that are also available for all consumers today. And a Wall Street loan simply means that we have to, by law, still prove the ability to repay, but we're not required to prove the ability to repay through tax returns, pay stubs, W-2s, and 1099s. Instead, we can use alternative methods of verifying repayment ability, such as bank deposits that can be converted into income, asset depletion. For example, you take $1 million, you divide it by 120 months, and we can give the customer credit for $8,333 a month. They have loans that are called 1099 only, which is what a lot of realtors fall into. Generally, you're paid on a 1099, you're self-employed, but there's loans that are called 1099 only that do not require the tax returns. And that tax returns is where you load all your expenses on, so your net income drops significantly. Well, there's a loan called the 1099 only loan that doesn't require the tax return, so we don't see those expenses. There's the DSCR loan, which is the debt service coverage ratio, which they use the rental income, the projected rental income on the rental house or whatever kind of property it is, to repay the loan. And then there's foreign national loans that are all grouped in the Wall Street silo number 2. The third silo is a no documentation loan. No income documentation loan is what I meant to say. No income documentation, no pay stubs, no tax returns, no 1099s, no W-2s, no K-1s, no nothing. This particular loan is United States United States Treasury loan. It is known as the community loan. Most lenders don't have any idea what that loan is. We do, fortunately, and we do them all the time. It only takes two things to get qualified. We need a 680 credit score, and we need 18 months of reserves in the customer's account after closing. So that's the caveat or the catch. 18 months of reserves after closing, and we can do a loan up to $3 million, up to $2 million, recent guideline change. Okay, with that said, that was last week's class. I'm glad to go over any questions with anyone that didn't make it and wants to know about what we just discussed. This week, we're going to go into more of the weeds of lending, and the first one is loan structure. So one of the things that we have to do immediately, and what I'm trying to help you understand as a realtor, is one of the first questions is to ask, how much cash do you have available for this transaction? And cash includes the down payment as well as the non-recurring closing costs that are associated with the loan itself and prepaying taxes. Your annual fire insurance policy is due, and funding an escrow or impound account up front. So when the customer says, I have $50,000 total cash to close, well, you've got to back out 10 or 15,000 for your non-recurring closing costs. Or they say, I have $300,000 cash to close, you're still backing out $10,000 to $15,000 of non-recurring closing costs. So they really have $285,000 cash to close. So with that said, the very first thing that I need to know, or we both need to know, is how much cash is going to go into this new home purchase so we can structure the loan appropriately, okay? And the way we structure loans is, let's see if I can get this other slide up. Give me 1 second here. No, that's the pricing. I'm sorry, I snuck this in last minute because it's kind of helpful. Let's see, where's my loan structure? That's my pricing. Okay, it looks like I didn't open it. Give me 1 second, and I do apologize for this. Should have had this open already. Okay, so when we talk about loan structure, what we want to do is assume the purchase price is 100%, and the most popular loan structure is an 80% loan to value, or an 80% loan, which represents 80% of the purchase price, with the customer or the buyer coming in with 20% down payment, which is also known as his equity investment in the home. So when an investor or a lender who's lending the money to the customer sees that the customer is coming in with 20%, that is a significant down payment. And it makes the investor or the lender feel comfortable that that buyer probably won't go belly up or bankrupt on that loan. The odds are pretty good that if they're coming in with a full 20%, that it's one of the lowest risk loans that he can make. And in that case, there is no mortgage insurance required. So 20% down is the magic number, the cutoff, where no mortgage insurance is required. And mortgage insurance is used for any loan that does not come in with at least 20% down payment. And mortgage insurance can be looked at. There are loans that have no mortgage insurance that are 15% down loans, but believe you me, it's built into the interest rate. So it's still there, it's just disguised, okay? So any loan under 20% down is gonna have a higher cost, either in a set-aside mortgage insurance that I can point a finger to, or a higher interest rate. The other popular loan structures that are available to a consumer, and this is why it's important to ask the buyer, how much money do you have, is because if they only have 3.5% down on the purchase price, then by default, the only loan out there is an FHA loan. And an FHA loan is a great loan, everybody. It is a fabulous loan. It squeezes customers into these homes that they normally couldn't have afforded, because how long would it take you to save up 16.5% more interest to get a 20% down deal? So if you can squeeze in at 3.5%, and if you can afford the MI cost with, say, a dual income, a husband and a wife, which it happens all the time, this loan is used for houses between, you know, 600,000 to even up to $1 million. These FHA loans squeeze customers into homes. They are fabulous loans. I love them because they're not permanent loans. You refinance out of them down the road once the equity catches up and you pay the principal down. So you can get into a home with 3% down. You can also get into a home on a conforming loan with as low as 3% down. So that's a 97% loan that the lender is going to give somebody. Now, what happens is the mortgage insurance on that loan is astronomically high because the customer's only coming in with 3%, but it still works. And if the customer can afford it, it's not a bad decision, because how long would it take for the customer to save up another 17%? You know, 5 years. Another structure is a 5% down loan. And if you can get to 5%, your mortgage insurance is cut way down. That 3% mortgage on a conforming loan right here is tough. And I've priced them before. I priced one this week, and it was a $630 mortgage insurance bill on a $525,000 purchase. No, I'm sorry, a $600,000 purchase, but it was a $600 plus mortgage insurance monthly bill with a 3% down. But when I went to 5% down, my MI got cut in half, and it became like a $315 bill. Now, a $315 bill to me is a cheap source of money if I can't save the other 15%. I'm renting that money, right? I'm renting it for $315 a month for a shorter period of time, because I'm not going to keep the loan forever. And I can get out of MI in 24 months or when the equity reaches 78%. We can go into that later, but that's another structure, the 5% down, cheaper insurance. 10% down with a 90% loan, even cheaper mortgage insurance. We do these all the time. You can structure a 10% down, 80% loan, and a 10% home equity line of credit. And in this case, you don't have mortgage insurance at all. This home equity line of credit, this additional second trust deed on the property, bridges that gap to get to my 100% purchase price. The problem with this is the prime rate is 8.25% today, and then they want another 2 percentage points of profit on top of it. So you're looking at a 10% plus interest rate, where a lot of customers will say, I'd rather just pay the $300 a month MI, and you can write off MI as well as you can write off the interest on that HELOC. Now let's talk about conforming loans, high balance conforming loans, and jumbo loans. These loans, when we're structuring a loan for a customer, we have to know the purchase price and how much down payment so we can back into a loan amount. And the reason we need to back into the loan amount is because all across America, from Los Angeles to New York City, Fannie Mae and Freddie Mac and the United States government, in its infinite wisdom, says we will lend every American $726,200 under our Fannie Mae Freddie Mac guidelines, which are the most attractive and least costly loans in the marketplace. So it's about parity, that all Americans are treated fairly. That number changes every year. Last year, it was $647,000. This year, it went up to $726,000. Next year, it'll go up again, and it goes up as appreciation goes up and home values go up. And then there are sections in America for cities like New York City, San Francisco, Seattle, Los Angeles, Dallas. They're considered high rent districts or expensive districts of the country, but there's huge populations in those mega centers where it's super expensive. And so the government, in its infinite wisdom, said, well, we've got to be fair to all Americans. So in these high rent districts, let's allow our conforming Fannie Mae, Freddie Mac loans go a little higher to accommodate for those higher real estate prices. So in certain counties, you can go up to $1,089,000 loan amount, and it still falls under the Fannie Mae, Freddie Mac guidelines. It's called a high balance loan. A high balance is going to cost more than a conforming loan, but it's not necessarily a bad thing because the guidelines on the high balance loans are generally neck and neck with the conforming loans, which are some of the easiest loans to qualify for at the end of the day. Just wanted to point out that San Diego County only goes up to $977,500, but that's more than the $726,000 all across America. Orange County in LA comes in at $1,089,000. Riverside is stuck at the $726,000. It didn't break a high rent district barrier, even though there's $1 million houses out there. The county as a whole drug it down. San Bernardino's the same. San Francisco gets the $1,089,000. Napa Valley doesn't quite get the $1,089,000, but it's not far. Kind of get a feel for all these counties and how they're priced differently. Sacramento County is 763, which is more than the 726, but not by a lot. And then Ventura County at 948. So you don't need to memorize this. You don't need to even know it. What you do need to be aware of is that there's conforming loans that go up to about 726 loan amount, 726,000. You've got a high balance area that, depending on the county, can go up to about $1 million, almost $1.1 million. Just keep that in the back of your mind. And then any loans that aren't going to fit these two categories or these two boxes, kind of by default, are a jumbo loan. And most of our jumbo loans start at $1 higher than the conforming limit, because they don't want to, jumbo loans and jumbo lenders, which is lenders like JP Morgan Chase, Wells Fargo, Bank of America, Citibank, your major commercial banks, they play in the jumbo arena as well as many independent mortgage banks will also pool jumbo money together. So New American Funding, the company that I work for, we have our own jumbo in-house product too. So with that said, you have three different categories of loans. All three of those categories of loans help us with the loan structure, which is driven by the customer's cash to close at the end of the day. So we look at the customer's cash first. First question we want to ask, understand how much down payment we have and set aside 10 or 15 grand for cash to close, non-recurring closing expenses and funding impound accounts and prepaying taxes and prepaying your fire insurance, all those expenses. And then we can come up with which bucket the customer will most likely fall in. And then FHA loans have their own set of parameters if we go that route. So that pretty much covers the loan structure. Let me check. Oh, God, chat ran away from me. I apologize. My bad. Okay, just reading through it. I did not attend the first session. Do you have a link for that class? Yes. I think it got posted. If not, it's on the OCAR website. If you missed it or didn't register for part one, you can view the class recording on the YouTube channel. Excellent. There's the YouTube channel. Also, I teach a class live to North San Diego County Board of Realtors. If you're interested in that class, email me at the email I gave you, jeffrey.scott@naf.inc, and I can shoot you the August 3rd class that's coming up at, I believe, 11 a.m. on that day. And again, I can, if you're interested. Is there a slide on screen? I hope you're seeing slides. If I'm missing something, please chat me. Handouts are there. We only see Jeff's contact on the screen. Oh, interesting. Okay, what's going on here? What's difference conventional and FHA and Freddie Mac? Okay, fair question. Fannie Mae, think of Fannie Mae as its own entity. It is a lender. It's its own organization with its own rules and its own regulations and its own guidelines. Think of Freddie Mac as its own entity. It's its own organization. It has its own guidelines. It's a little more liberal, generally speaking, than Fannie Mae, Freddie Mac is. And then think of FHA as the most liberal, okay? Their rules are super aggressive to the benefit of the customer. They do the low credit scores. They do the low down payments. They do the high loan to values. They're the riskier loans that Fannie and Freddie won't take, and they fall in the FHA bucket. Then the word conventional is a little confusing because all these loans are conventional loans because you think of them as loans off the shelf that you just go buy at Target and pull it down and put it in your basket and you walk out with it. It's conventional loan. The word conforming means that it conforms to Fannie Mae's and Freddie Mac's guidelines. It conforms to the rule books that Fannie Mae and Freddie Mac have. Think of America's government wanting to have parity for all borrowers from LA to New York City and everybody in between. They need to be treated equally. And so the guidelines are these books, 1,200 pages that the underwriters have to know. So if all those guidelines are met, then it is a conforming loan. It conforms to those guidelines, and it will be bought ultimately by Fannie Mae, Freddie Mac, or FHA. And each of those have their own guidelines. No document loans, what requirements? Okay, there's no such thing as a no document loan. Okay, you will always have to provide documents. There could be a no income document section that is not required. Okay, so the income docs is really what's in question. So today we have a no income document loan. It's not my loan, it's the United States Treasury's loan. It falls under the community program or the community loans. And you don't have to provide any income documents. You don't have to provide pay stubs. You don't have to provide tax returns. You don't have to provide W-2s, 1099s, or K-1s. What you do have to do is meet a minimum credit score of 680. And you do need a minimum of 20% down. And you do need a minimum of 18 months reserves for PITI, which is your principal plus interest loan payment, plus your taxes, plus your fire insurance policy, plus any HOA or community fee that could be associated with owning that house. So you not only have to have your 20% down payment, but then you have to have an additional 18 months stacked up in a bank account somewhere and accessible to you. Then you can get a loan without the income docs. Foreigner mortgage requirements. Foreign nationals can buy a home that's a second home or an investment property without income docs. And it's generally done, particularly on the investment properties, by using the rental income that that investment property will throw off. Now, do foreign nationals buy an investment property using the income that it's supposed to throw off and move into it and use it part of the year? It happens. So that's how that foreign national works. FHA loan is more strictly requirements and spends more days than conventional loans. Strictly requirements and spends more days than conventional loans. Okay, I'm going to do my best with this one. FHA loans are not more strict. FHA loans are more lenient in most areas. FHA loans have some particular items that have to that are different than a Fannie Mae or Freddie Mac loan. But overall and generally speaking, you can consider an FHA loan basically what our old days subprime loans were. They are not a paper. I can do a 620 FICO score. I can actually do a 580 FICO score with it manually underwritten. My debt to income ratio does not have to be capped at 45% like it does on the Fannie Mae, Freddie Mac, and Fannie and Freddie loans and most jumbo loans, or even 43%. FHA goes to 49.9 almost every time. And depending on the quality of the loan, reserves, down payment, FICO score, we can go as high as 56.7 or 56.8 debt to income ratio. We have seen debt to income ratios that high. They're super high. Email me any questions if I didn't answer that correctly for you, okay? Are you seeing lending tightening taking place for all types of loans now? Absolutely. Fannie Mae and Freddie Mac started their tightening a year ago. We used to get loans through at 51, 52% debt to income ratio on Fannie Mae and Freddie Mac. It's a hard stop now at like I'm getting stuck at 45 right now on several files. You know, even with what happens if you come in with a 680 credit score, that's an average credit score, right? And the banks don't like average. Fannie and Freddie don't like average. They'd rather see a 760 credit score or a 780 credit score, something that's really high on the chart. Then they're going to give you a little more. See, all these loans are written off of algorithms, and these algorithms they can tweak at any point during the year. And so if they see the market teetering like we are teetering on a recession, they're going to tighten those restrictions up, and they're not going to let a 49% debt to income ratio go by. They're going to hold firm at 44.999, which is right under 45%. So yeah, definitely tightening. An independent broker with NMLS ID and other state lines, and how can I submit loans to lenders? Gil, not my topic, not my class. You're gonna have to, that's a whole different animal. Don't need to even know where to start with you. If you'd like to email me, I can give you some suggestions. Are you seeing more appraisal issues as bidding wars are still going? Yeah, a little off topic, but yeah, what's happening is look, we're short on property, and we know that. We're short on inventory. We're 1.5 million homes short across America for the demand that there is, okay? We are not building homes fast enough. What occurred after the mortgage market meltdown of 2006 and 2007 is that everybody was bankrupt by 2008, 9, and 10. And builders today do not want to ever get caught in that again. There was like 4.5 million homes available at that point in time for sale across America. And they were still building and knowing that they could get those sold, and it didn't occur, and they got slaughtered. So today, builders, they're building smaller tracts, they're building them slower, they're letting them get sold or pre-sold to certain levels before they start the next track. It simply means we're short of homes. We're going to continue to be short of homes. The demand is so strong because of COVID. It was so strong because of the low interest rates. Everyone can work at home. Everybody that lives in Seattle wants to come to, San Diego or Southern California, and move out of San Francisco and move here. So homes in Southern California, we're going to see another we're in a recession, whether you like it or not, or believe it or don't believe it. The numbers are there, but we're still going to see a 4.8% annual appreciation in homes this year alone. So, and there's multiple offers going out on properties continually. If the house is priced right, it'll be tied up in a week. It's just the way we see it. What is the source of funds for the FHA and Fannie Mae and the government? Well, these are quasi-governmental agencies. Again, off topic, it really doesn't have, but you do need to know it. Fannie Mae is a quasi-governmental agency. It's overseen by the United States government. It is also a public entity. It trades on the stock exchange in Wall Street. It has fiduciary responsibilities to its investors to theoretically make a profit. But the United States government controls them and oversees them for the good of all Americans. So Fannie Mae is one entity of two entities, which is Freddie Mac. It's its own entity, and it runs similarly. FHA is under the government's housing department, and it is funded by the government. And I do not believe FHA is a publicly held company. I don't believe they trade. You could look that up, but they are governed by the government. And then the United States Treasury has its own loan for people that cannot get one of those loans. So these are all different entities. You can Google any of this and study up and get much deeper than I can even begin to explain. Okay. Any other questions before I move on? Questions? Yep. All right, great. And then questions and answers, I see. Okay, great. All right, guys and gals, ladies and gentlemen. All right, so I believe the next section is loan pricing. And the question is let's see, where am I at? Loan structure we did, and this is the beginning of the loan pricing. So I'm going to shoot over to this document real quick. All right, so loan pricing is really an interesting animal, and I want you guys to just take a moment and try to absorb this. We get customers that call us up all the time and say, "What's my rate? What's my rate? What's my rate? What's my rate?" I can't answer that. The reason I can't answer it is because Fannie Mae, Freddie Mac, FHA, jumbo lenders, Wall Street lenders, everybody has moved 15 years ago, has moved to what's called risk-based pricing. Risk-based pricing means each individual gets priced for a loan dependent on that individual's risk profile and what makes up a risk profile. Well, the things that I need to know right off the bat is what's your FICO score? What's your credit score? Because if you fit in a tier of 620 to 640, that's a pretty crappy tier. So you're going to get priced higher. And then if you go from a 640 to a 660 tier, your pricing improves a little. And if you go from 660 to 680, your pricing improves a little. And if you're a 680, that's average America. So you get an average price, right? If your credit score is a 740 to a 760, that's kind of an A, right? An A, maybe an A, moving into the mid A's of all borrowers. If your credit score is a 780 to an 800, You're an A plus, so shouldn't you get a better rate than the guy that's got a 620 credit score? If you got an 800 credit score, your risk profile is different. You're less likely to default on the loan, hence your pricing is different. The other thing is loan to value. So if a customer calls me up and says, what's your rate? Don't know your FICO score. I also don't know how much down payment you're putting down. Are you putting 20% down? Are you putting 3.5% down? If you're only putting 3.5% down and you get you lose your job and can't make your payments on it, and you're only invested 3.5% down, you could just walk from the house and say, boo, I made a boo-boo. But if you got 20% of your money in that loan and in that house, and you lose your job, you might scramble and get 2 part-time jobs to make the payments and to protect your investment in the house, right? So you're going to get a better interest rate. But what about the guy that puts 50% down on his house? He's one of the lowest risk people. Therefore, he gets a lower interest rate because he's a lower risk. The other thing I don't know is what's your property type? So the customer says, what's your rate? What's your property type? Well, what do you mean? And I go, well, a single family residence is priced differently than a condominium. And a condominium is priced different than a duplex and a 3-plex and a 4-plex. Or are we talking a manufactured home? All of those carry different risks. Customer says, what's your rate? I'm like, well, what are you going to use the property for? Well, what's it matter? Well, it matters because if it's an owner-occupied property, that's the only roof over your head. So you're going to protect that with all your might. You're going to really, really do everything in your power to not lose the roof over your head. But if it's a second home in Big Bear and it's not ski season and you're in financial trouble, you're like, well, I can't make the payment on Big Bear this month. So your second homes are more risky. And then if it's an investment property and you have a rental house in Phoenix and the tenant stops paying rent and you're in a financial quandary, you're like, well, bummer, can't make my mortgage payment, right? And that's your most risky. So, because you have very little, tied to that at that point in time. The other thing is what's the loan amount, right? Is it a conforming loan? Is it a high balance conforming loan? Is it a jumbo loan? Those are all different. If mortgage insurance is needed, that triggers the pricing because mortgage insurance means you didn't put 20% down. So you're a higher risk person automatically. What's the loan term? All these loan terms get different rates. Even the loan programs get different rates. So, and then are we talking, can the customer qualify with tax returns or no tax returns? And if they can't qualify with the tax returns and they fall in a no tax return loan, it's a higher rate by default. It's a higher risk. I don't have tax returns to verify the income. And then your no ratio loan, which is the United States Treasury loan, is a higher rate. And then hard money is private lenders, and that's the highest rate. So when customers come at us saying, what's your rate, what's your rate, what's your rate? I could say 5% because I could buy the interest rate down with 20 or 30 or 40,000 extra dollars that the customer would have to pay to get that 5% rate. But that doesn't make sense, right? So it's really hard to just give somebody a rate. But if you hardcore press me for a rate, and you're not willing to help me out and understand the situation, I can deliver a 5% rate on anything. And I will just have to backload it with $40,000, $50,000, $60,000 in points to deliver that 5% rate, but it can be delivered. All right, so I hope that helps you guys understand pricing because it's all risk-based. I've heard of higher credit scores is getting penalized. Okay, so the anonymous attendee brought up a really good thing. What you're referencing is something called LLPAs, and I was going to kind of loop back to that later because but it's an interesting and it's a hot topic today. Let's go to the presentation. Let's open up it so you can see it. Where's this button? Okay, so these are called LLPAs. This is a chart that I just pulled out of the guidelines to show it to you. LLPAs stand for loan level pricing adjusters. They take into consideration all of those pricing points that I just told you about that make up the price. In this particular range, this shows a 740 credit score under 60% loan to value. There's no charge. Whoops, what happened? Okay, there's no charge for that. There's no fee for that because it's the lowest risk when you've got over a 740 credit score and a 6, and you're only you've got a 40% equity stake in your house, so you only need a loan of 60% loan to value. No fee. And as we move down the scale in terms of either dropping worse credit scores or, whoops, let's see if I can move this thing out of the way. There we go. As we lower credit scores down the left-hand column, you can see over in these boxes, the prices start to get tacked on. And these are not, we're not adding this cost to the interest rate itself. These are the costs, and I'll explain it in a minute, for that rate, okay? So if the customer is only going to come in with 10% down and it's a 90% loan, which would be here, and his credit score falls in the 660 range, he would be looking at this 2.75% in additional points to get any given rate. That's added into it. So loan to value and FICO score are your big adjusters to the LLPAs. This particular slide shows that at 75%, I just picked out an investment property. See how that gets tacked on 2.125% points. Okay. If you put in less than 20 or 30% down or even 25% down, that number jumps to 3.37 points. This LLPA is product type. So you can see 2 units automatically get hit 1 point additional. Condominiums get hit 75 basis points additional, right? So that's why it's important that I know if it's an a single family residence home or a condominium. This one is a high balance. Again, we got to structure the loan so we know which bucket it's going to go into, whether it's be under 726,000 or under 1,089,000 in LA County and Orange County, and or is it going to fall into a jumbo bucket. This right here is if the loan happens to be a cash out on a refinance. So cash out loans are more expensive because the customer's getting cash in hand, okay? And the lender really doesn't know what they're going to do with that cash in hand, but that's the risk. So they get hit a fee. And so the question is there is a hot topic out there right now about LLPAs, and let me go to it. I need to pull up a slide that I wasn't prepared to talk about, but I have it right here. And it is right here. So check this out. So this is exactly what you're talking about. Can everyone see that? Let me just see. Can someone just throw in yes somewhere if you can see this? So this is what happened recently with the United States government, and it's become quite a hot button with Fannie Mae, Freddie Mac. And what it is it's showing that higher quality people were actually getting hit with higher LLPAs than they were in the past. And so the movement was to try to make more money for Fannie Mae and Freddie Mac by offsetting, by collecting higher fees going into the transaction to offset losses that they've had in certain buckets over the last 10 and 15 years. It's kind of like payback time. So this is what has occurred, is that you can see that you know, a customer with a fairly decent credit score of a 720 to a 739, and he's coming in with a 15% down payment, and he's at 85% loan to value. He's now getting poked 75 basis points, where in the old days, it might have only been 25 basis points. So is he paying a premium to offset the losses in these other areas over the last 10 and 15 years? The answer is yes. Have they changed it? The answer is no. Will they change it? Who knows? Is it fair? Not really, but it's done. Okay. And so that's what all the hoopla is about. So they did a reshuffling of all of that, and they're trying to collect for last 10, 15 years losses in certain buckets. And if you want to know another bit of trivia, remember the mortgage market meltdown in 2006 and 7 that destroyed the market by 2013? Home equity line of credit lenders, HELOCs, all loans in second position were virtually decimated and crushed and wiped out, a lot of them to zero. I mean, like charcoal land, like nuclear meltdown in the HELOC sections, because they were all in second position, right? Remember that LLPA about condominiums costing 0.75 basis points? It's a direct result of 2006 and 7's mortgage market meltdown, and all of those HELOCs that got wiped out. We're still paying for it today. Condominium buyers, and I own a condominium myself, I paid an extra 75 basis points in cost for my condominium, for my loan for my condominium. They're still trying to collect. It's a mess. Okay, with that said, let's see where we're at with I got chat going. Chat says I can't see. I'm still in loan pricing. What's my rate? Okay, I'll move along. Questions. I've heard of higher credit scores getting penalized. I just explained that. You can email me if you have more questions, or if you want a copy of the chart. Not that it really matters to you, but it's good to be aware of. But I wouldn't make a big thing about it with a customer. Do you want the house or do you not want the house? And I promise you this right now, interest rates don't make you, high interest rates do not make you money. What makes you money is owning the real estate itself. Owning a $700, $800 million asset is where you make money regardless of the interest rate and regardless of these extra costs. These costs, you're looking at pennies on the floor when you should be focusing on the dollars above the table. And dollars above the table means owning real estate. If you rent, you're paying 100% rent, 100% interest. Talk about high interest rate, rent. It's insane. You've got to own to ever get ahead, regardless of interest rates, regardless of where we're at today. Owning is what we got to focus on. Why is the rate highest when the LTV is around 75 to 89? Email me that question. We'll sidebar that one. So how come refinances always get better rates? They don't. They don't. Refinances don't always get better rates. See, a cash out refinance would never get really a better rate because they get hit for a huge cash out fee. FICO scores drive it. A lot of times purchases, because it's new money, gets a lower cost for that particular rate. Rates are rates, okay? And it's dependent on each customer's situation. I've heard of higher credit scores getting penalized for lower credit scores. I think we just went over that. It's in the conforming bucket mainly, where those LLPAs are added on. Here's an interesting sidebar. You guys ready for this one? Let me show you something that's pretty fascinating. So guess what? Interest rates don't go up and down. Yep, I said that. Interest rates don't go up and down. What goes up and down is the cost of the interest rate. A 5.5% interest rate is a 5.5% interest rate, regardless of anything. It doesn't go up and down, it sits there at 5.5. What goes up and down is the cost of that interest rate, because there is a cost to get an interest rate. And if the cost is 0, then you're going to have a higher interest rate. And I'm just trying to bring this all together from the perspective of really understanding interest rates. Let's take a number right here. This is today's 30-year fixed conforming loan. It's not a high balance loan. It's not a non-conforming loan like a non-QM loan, and it's not a jumbo loan. This is your Fannie Mae 30-year fixed. If I wanted a 5.5% rate today, let me just do this real quick so I can mark on it. Okay, so if I wanted a 5.75% interest rate today, it is deliverable, but it's going to cost me $16,000 to buy that rate today. Now, tomorrow, it may only cost me $15,000. And the next day, it might only cost me $14,000. And the next day, it might only cost me $13,000 as rates drop, right? This 5.75% rate costs 5.4%. So it's the cost that goes up and down. These rates always stay the same in the left-hand column right here. These never change. This is what changes, the cost of these rates. So if I go down to the bottom of the rate sheet, and I'm going to do the same thing, I just want to copy and paste it, or copy it so I can kind of mark on it and show you. If I go down to the very bottom of the rate sheet, my 7.625% rate is only costing $2,700 today, right? So that rate never changes. This rate never changes, but this changes every day. And there will be a time when it costs 0, and that's called a par rate. And so rates don't change. What changes is the cost of the rate. The cost of the rates today are very expensive. That's why rates are high, because we've just moved into a new realm of interest rates. Will it come down? Absolutely. We project that it'll be down probably, if we get really lucky, by the end of this year, by the end of first quarter, we should be back to like a 5.75% interest rate. What's happening is the inflationary numbers are coming down, but they're viewed on a 12-month rolling average. And so they're using the last 12 months average as the number, and as each month gets lower and lower and lower, the average slowly gets lower, and as inflation drops, so will interest rates. So we're going in the right direction. It's just going slower than we want right now. Okay, so that was just a little tidbit on interest rates. All right, so chat's gone back up. Still looking at the same exhibit. There's nothing. Okay, Elsie, are you here?
I am.
What is going on that I'm missing in chat?
Let me see. I don't see, I think you're pretty much answering everything. You have everything in the Q&A already, correct?
Someone's saying 1254. Someone's saying, I'm still looking at the same exhibit. That has nothing to do with anything the speaker is saying. Same here. The exhibit did not move. When are you going through heat cost? We were looking at the wrong screen. So I'm seeing screens that the customers or the realtors are not seeing.
What slide are you on? What I'm seeing is the loan pricing. What's my rate screen?
Yeah, that was that one. And then I had popped onto a Word document that had pricing. Let me pull it back up again. I think what about this one?
No, right now I still see the PowerPoint. So I think when you're switching
Hmm.
out of it is when
Gosh, okay, I'm sorry. I didn't realize that. I thought that they were able to see anything that I saw on my screen. I thought it translated as a share, but apparently it's not. My apologies. I didn't know that. I can't pull those slides into PowerPoint right this second. If you'd like, if you have questions, specifically tell me what the questions were that you didn't see the screens. I'll screenshot them. I'll email them back to you. Again, use my email address. It's jeffrey.scott@naf.inc.com. And
if
I'll,
you go out of the or do the share screen one more time, I know it does give you a few options and it should actually, there should be one that would mirror everything that's on your screen. So if you're going to different programs, it should show if you want to try that. Or
okay,
if not,
I'm mute, stop, participants chat, question and answers, new share. Is that what I'm looking for? New share?
you can try that, or you might need to stop and then just do it one more time. We can do stop participant sharing and then try to reshare.
Yeah, I hate.
I think that's going to work.
Well, it's 1 o'clock and I'm winding down. So I think what I'm going to do is just ask, and first I'm going to apologize to everybody that you did not see those screens, that they're helpful from a visual standpoint. Email me directly what you believe you've missed. I'll get it emailed right back to you in the next, by this afternoon. Okay.
Or if you want to email me those documents, I can include them with the handouts that I have as well.
Okay, great. I can do that too. Oh, great. That's a great idea. Okay, great. All right. Let's see. So we went through the LLPAs. What does underwriting mean? We've kind of hit this one kind of hard at this point. Underwriting simply means that these are the guidelines that the underwriter has to abide by to approve the loan at the end of the day. Think of it as a playbook. I actually might even have a copy. Well, I don't want to go back and try to show a screen that I don't have, but I have the PDFs if you'd like a copy. The PDF is 1,200 pages for Fannie Mae. That's 1,200 pages of guidelines that an underwriter has to know. If the loan meets all of those guidelines perfectly, then it's an approvable loan. Freddie Mac, if you would like their guidelines, they come with their servicing book. It's over 2,000 pages in PDFs. I'm glad to email you that. Send it to me if you'd like to see it. It's just kind of food for thought. When you're talking Fannie Mae, Freddie Mac, jumbo loans, then you have these huge guidelines that the underwriter has to follow, the huge playbook. When you go to the jumbo lending, jumbo lenders, they don't have these guidelines. It's not as complex. They're stickier, meaning they're more conservative, and they don't do a lot of things that Fannie Mae and Freddie Mac will do. So these jumbo guidelines, maybe 200 pages. If you go to the non-QM section where you're underwriting a loan based on 12 or 24 months of bank statements, or you're underwriting the loan on asset depletion, or you're underwriting the loan on these Wall Street loans on future rents of a rental property, maybe 75 pages of guidelines, maybe 50. I mean, there's virtually no guidelines compared to Fannie and Freddie's thousands of pages of guidelines. Then the community loan, the no ratio, because it has no requirement for income documents at all. It's 24 pages. What's your FICO score? Do you have 20% down payment minimum? And after you make your 20% down payment, do you have 18 months of payments stashed up in an account somewhere? So 24 pages is more than enough for guidelines. So that's kind of what underwriting means at the end of the day. Lastly, just kind of a couple hot topics. One is what's called a buy down. I don't have a slide here. I can see if this PDF will pull up. Yeah, the PDF's not actually there. So a buy down is a tool that we use. Why a realtor would want to know what a buy down is because the sellers sometimes will give seller credits towards the non-recurring closing costs of a loan for the buyer. Sometimes those seller credits are big enough that we can use what's called the buy down, so I can buy the interest rate down for the borrower at the end of the day. Buy downs come in two forms. There are permanent buy downs, and then there are temporary buy downs. A permanent buy down would be where I buy the interest rate from 6.75% and I pay 1 point, and I'm just making these numbers up, of the loan amount in a fee. Then the bank will give me a 6.5% permanent interest rate for the full 30-year term. A temporary buy down is where we can buy the interest rate down by, say, 1 full percentage point in the first year. That's called a 1-0 buy down. So temporary buy downs come in a lot of different flavors. They can come in a 1-2 buy down, which means they buy the interest rate down 1% for 2 years. It can have a 3-2-1 buy down, so it buys the interest rate down by 3% the first year, 2% the second year, and 1% the last year. Buy downs are nice when home buyers are moving in and they want to lower their expenses for 12 or 24 months because they've got all the other additional costs of moving. So the buy downs are pretty big things. There's another program that's called NAF Cash that I wanted to call to your attention. Where NAF Cash comes into play is when you're working with a buyer who's been in the market, who's made multiple offers and keeps getting smoked by the all cash buyer, or keeps getting beat out because he needs to get a loan and the sellers don't want to take on the loan risk for whatever reason, and so they're jumping to either the faster close people, buyers, or the all cash buyers. NAF Cash is a program where I'll go in, I'll buy the house for your customer all cash in 7 days. I'll give you a bank statement showing $3 to $4 million or even more in that account, so you can show the seller. We'll take the house off the market immediately and we'll reserve it for your buyer at the end of the day. If your buyer is renting a place right now, then we can close. He can buy it from me in the next 10 days and move into it. If he's got a house, a departing residence that's going to be for sale and he's going to put it up on the market, then in that particular case, there's a 90-day window where he markets his house, ultimately gets it sold, and then buys the house back from me. So this is an accommodation program of New American Funding. This is Patty Arviello's money. Patty Arviello is the owner of New American Funding. She is, her goal in life is to help as many home buyers buy a home that she possibly can while she's on this planet. She's a very interesting woman. Google her. She owns $1 billion. We're the 12th largest independent mortgage bank in the United States. She's a sole owner, okay? Woman owned. Latina. We think she may be the richest Latina woman in the United States. This is her money that's supporting this program. It's an accommodation loan. It's not designed to be a profit center. It's not designed to lose money, but it's not designed to be a profit center. It's designed to help buyers get that home. The benefits is that you can close in 7 days. The realtor gets paid in 7 days. You generally speaking can negotiate a cheaper or a price lower than the list price when you're paying all cash in 7 days. The buyer only has to move once, because once we own the property, we'll give the keys to the ultimate buyer so they can move in slowly over time while their departing residence is sold. So there's only one move. We'll even allow them to carpet, paint. We'll give them the keys in 7 days too, and they can carpet and they can paint and they can landscape and make improvements. They cannot tear out a bathroom or a kitchen or the roof or do any major construction things, but they can make improvements during that 90 days, which is a nice benefit. Then the buyer gets the keys in the first 7 days, well, at the 7th day when we close and take title. We also offer a 1.0 buy down at no cost. So what that means is that the customer's rate is 6.75% on the loan, that in the first year, they only have to pay the 5.75% rate for the first year. And that's coming out of NAF's pocket at the end of the day. And then we offer a 5-year rate protection pledge. So if they do refinance, which we expect them to refinance, right, because rates should be lower by the end of this year and first half of next year, that we have a rate protection pledge where they don't pay repeat fees. So it kind of ties them to NAF on the refinance. With that said, let's see if I can, that's pretty much it. If there's any remaining questions, which I don't see. Is Wall Street the same as non-QM? The answer is correct. Wall Street loans, non-QM. What came out of the 2015 TRID laws was a distinction between Fannie Mae, Freddie Mac, qualified loans. A qualified loan has qualifications to it. And then they have allowed Wall Street to offer non-qualified or non-QM loans that break the rules of the qualified loans. And so it's a different bucket, it's a different silo, it's a different animal. It's Wall Street money, correct? Anybody that has any questions, feel free to email me. There will be a recording available in time, probably a day or 2 or 3. Handouts are available. And what is your social media information? I'm on LinkedIn mainly. I do have a Facebook page. I don't live on it. My Twitter account's pretty dormant. So really LinkedIn is mainly where I'm at. You did mention that NAF covers the 1% 1.0 buy down. Yes, I mentioned that. Yes, that's part of the NAF cash program. That's not part of any loan. If you're using and utilizing the NAF cash, which I need to get you trained for, it's a half-hour Zoom class. There's no test. It's a Zoom meeting, but they want you to understand the particulars of it. Then yes, we pay for the 1% buy down as part of the NAF cash deal. Cool. Okay, everybody, I hope that was of some value. Again, if you missed the first class and you want to loop back around, glad to accommodate you in any way I can. Thank you all very, very much. Bye-bye.